All right, we're joined today by Andrew Gubbles, the CFO of Gold Royalty Corp. They trade under GROY on the New York Stock Exchange, and year to date they're over 190%, I believe. So great performance due to a bunch of reasons, which we'll talk about today. So Andrew, good to have you with us today.
Thanks for having me.
Of course. My first question was for investors that are, unfamiliar with what a royalty company is. Maybe we just get an overview of what that is first, and then we'll go into your performance.
Yep. So a royalty company, different from an operating mining company, holds contracts. We have contracts to receive a percentage of revenue, typically, of mining operations. Also, we can have stream agreements, which are also contracts. So we don't actually operate any mines themselves, and that the beauty of the model is that we have exposure to the commodity prices, full exposure to commodity prices without exposure to the underlying operation. So operating costs, capital costs, don't accrue to us, just the revenue from the operation itself. And because we just own contracts, we're able to diversify across a number of different royalties and streams, and manage a much larger portfolio than what an operating company could do.
Right. So you just said, you do manage a great portfolio. You have around 250 projects in your portfolio. You IPO'd at around 18 projects, I believe. What was the trajectory and the key to, growing that big of a portfolio?
Yeah. No, it has been an impressive growth trajectory and quite a ride to date. In under 5 years, you're right, we went from 18 exploration stage royalties. So royalties on existing mines that didn't produce, didn't contribute any revenue, no gold equivalent ounces, to today, we have over 250, as you mentioned, royalties. We generate over 5,000 gold equivalent ounces in revenue in 2025 in the $15 to $20 million range, depending on how the fourth quarter plays out. So we have moved the company quite a bit over that period and built a good diversified portfolio. And how do we do it? We have 4 key pillars of growth, which differentiates us from some of our peers. Of course, we, as a public company, after we listed, looked to grow the company through consolidation, through M&A with our peers. We acquired 3 listed companies in the first 2 years of existence in Ely Gold Royalties, Abitibi Royalties, and Golden Valley. That provided a good base foundation with quite a few development stage assets in it, but also some producing assets. Subsequent to that, we added assets through acquiring third-party royalties, and that's the other source or other way to grow, is acquiring existing royalties either held by corporations, other mining companies, held by prospectors. Acquiring third-party royalties is a good way to add royalties to the mix, and we certainly did that. The third way to add royalties, and something that we had done, is we financed development. We financed the Borborema mine construction by Aura Minerals in 2023. We provided that financing. In return, we got a royalty on the back end. And then lastly, and this is where we're a bit unique in that we've got a fourth way of generating royalties, which has really created that long tail of exploration royalties in our portfolio. We have an organic royalty generator model. Now that is really through our acquisition of Ely Gold Royalties. We have an individual in Nevada who's able to stake claims on properties. Those properties, we, after staking the claims, are optioned out to other explorers. We earn option payments from those explorers, and after they've done their work on the back end, we get a royalty, and we keep that in the portfolio. So we've added quite a few royalties over the last, since inception or since acquisition, over the last 4 years during that model.
Right, and you did speak about prospectors, so you get some royalties that prospectors like personally have early stage, right? So how do you kind of manage the some risks with that and also still maintain your growth?
Yeah. It's all a balance. There's prospectors who have early stage royalties.
Some of them are private, like sometimes.
Yep. Yeah. Certainly, there's prospectors with early stage royalties. There's also prospectors have held royalties for a long time, to the point where they've held royalties. The mine have been fully developed and producing and are earning cash flow. For instance, an example of one that was in the development phase that we acquired from a prospector was the royalty on the Cote mine, which was being built by IAMGOLD at the time. We acquired that royalty as it was through construction, and now that it's fully developed, we're earning revenue. So in terms of managing that risk, it's a matter of making sure we have a balance of assets in the portfolio that are in development stage and producing, as well as exploration. To be honest, as a royalty company, we have no real control of the operations, what happens underlying the company ourselves. We can control what we do, but to be able to mitigate the risk beneath what we do as a management team, it's really having proper diversification, which is what we have with 250 royalties.
Right, and if you were an investor, that's already in your stock or looking at it, what are the key assets that are gonna either come to fruition in the next 12 to 24 months, or that are really gonna support your company?
Yeah. So again, I think if you look at the landscape of royalty companies, and you compare the junior royalty companies, for instance, so sub $1 billion market cap, which we sit in that category. I would say we, Gold Royalty, is unique in that we have cornerstone royalties on some of the largest gold mines in North America. And our North American exposure is also a unique characteristic. Around 90% of our net asset value of royalties is in Canada or the US. But you asked about the mines itself and the projects. A couple of the key projects in our portfolio that will come online and contribute materially in the coming years include the Ren deposit, which is the northern extension of Nevada Gold Mines, JV between Barrick and Newmont. Nevada Gold Mines Gold Strike operation in Nevada. Now that is a 1.5% NSR and an MPI as well. That will be coming into production in 2026, at the end of 2026, based on Barrick's numbers. It's already permitted. Construction has already happened. We've been to site. Actually, a good third of their estimated capital spend has happened already. And by 2027, that deposit will be ramped up and we will be starting to earn full revenue from 2027 onwards. So that is one that certainly has a lot of value coming online. The other one that is a significant royalty in our portfolio that provides a lot of growth is the underground at Canadian Malartic. And that's really our flagship. That's the Odyssey deposit. Odyssey, Agnico Eagle has already started building the shaft in Odyssey. As the pit is mined out, there's more production coming through development in that underground. We've got a 3% NSR over a portion of the Odyssey deposit. Once that is ramped up through our area, that will be our largest cash flow generator. We expect production through the underground to start ramping up in 2027 with material contribution to Gold Royalty in 28 and 29.
Right, so there's obviously more revenue coming and more growth for the company, but also in Q3 you did have really good results with a positive cash flow and a great ABI TDA. Do you want to go over those results quickly?
Yeah. So the third quarter was a good continuation and from really the first 2 quarters of the year as well. If you followed the history of Gold Royalty, as we built the company, we went through a period of growing the portfolio. We had to really find assets that provide us with a foundation that made us into a real sustainable, competitive royalty company within the junior space. And to do that, we ended up acquiring a few cash flow generating royalties, which were quite important. I mention that because what was happening before 2025 and 2024 and previously, we did a couple of merger acquisitions. We had a good growth portfolio, but we continued to burn cash. With the acquisition, with the merger transactions, acquisitions, there's duplication, there's costs associated with those. We're able to take that out of the business, reduce our G&A to a very stable level, which we are now. But at the same time, those additional cash flowing royalties that we added to the mix really created an environment such that by the 2025, in the first couple quarters, and certainly in the third quarter, we're generating positive free cash flow. That creates a sustainable business. In fact, since June of this year, we're able to pay off $7 million of the debt we had drawn on a revolver. And we have stated that priority to reduce debt on the balance sheet. Of course, we drew on the revolver for some of the acquisitions. So this past quarter, because we've got that growth pipeline, as mines come online, getting full production out of Côté, Borborema, and Varus contributing in this quarter where it wasn't part of the story previously, really has resulted in that record revenue and record EBITDA. And I expect going forward, because of the growth profile and the very flat cost structure that we have, that you'll see future quarters where we're saying record revenue growth, record EBITDA. But certainly what you're going to see going forward is meaningful margin expansion above, again, a very flat cost base as more projects come into production.
Yeah, and you're obviously like the byproduct of all the decisions you've made, it like the really good financial decisions, but there's also a win in the back. Obviously, the prices of gold are at all-time highs this year. How did that affect you? And I want to know as well, you are cash flow positive in Q3, but what is the price where you kind of break even, the price of gold, where that starts affecting you?
Yeah. So as a royalty company, of course, without any hedging, we want to maintain full exposure to gold prices. And oftentimes you sort of hear the reference, well, royalty companies, they don't provide as much torque to gold prices. We've done some empirical analysis, and I do believe there has been a page in our previous presentations that showed our beta to gold prices, and it's just as much as a developer. It's just as much as a producer at this stage. And I think that's because we have such high growth, and we have been investing in assets that are very high margin. We have been beneficiaries of the gold price going forward. And because as a royalty company, we don't have a sort of all-in sustaining costs threshold. We don't really have a lower end break-even point. We're always going to earn revenue as long as we're earning more than our G&A. And our G&A is around $7 million per year. As long as we're making more of that from our royalties, very long-dated royalties, more coming online, the gold price would have to drop substantially to the point where we were breaking even, so to speak, on a cash flow basis, operating cash flow basis. It would, I couldn't even tell you what the number would be, but at these levels, and even at long-term gold prices, we're still making positive margins. And because we're not an operator, we don't have exposure to operating costs. You're not completely de-risked as a royalty company, in the sense that if gold prices drop and gold mining operations or other mining operations cease production, of course, we're not getting paid anymore. So I think more the question is, if gold prices drop materially, if that impacts the operators and they're not paying royalty companies, ergo, we would have less. One of the benefits I think that we have with that portfolio I mentioned, mines like Odyssey and Côté and Ren are very, very productive, high-grade, low-cost operations run by majors. The risk of those ever being put on care and maintenance or shut down because of low gold prices are very low.
Right. And what are the main costs? I guess is it just like interest on your debt, things like that, and
Yeah, from a free cash flow perspective, yeah, the service charges does have an impact. The operating costs are a flat organization. It's really the salaries of our employees. It's the office expenses, professional fees, administrative costs. We have a small office, as I mentioned, in Nevada. We're listed in New York Stock Exchange, so the regulatory costs are slightly higher than if we were just in Canada. But that's really it.
Right. And
Yeah.
what's the capital structure of the company now? I know you're
Yeah.
moving towards being more of a institutional stock, right?
Yeah.
What's the capital structure?
Yeah, yeah. So again, we've got a market cap of around US $700 million at the moment. We have a revolver with a $30 million revolver with $20 million drawn at the moment. There is an accordion feature available if we grow. We have been steadily paying that down. We have convertible debentures, which are outstanding $40 million, which we issued to acquire or to finance the development of the Borborema asset project in December 2023. Those are very much in the money. I think most market observers call that equity for the most part. It would be to the benefit of debenture holders to convert at the prices at the moment. So, capital structure really is the $20 million of debt we have outstanding on a $700 million market cap.
Right, right. But what's like, let's say, the insider ownership of the company? Is it that's still high, or how?
Yeah, I mean, we're about insiders being management, board, other insiders, individuals is around 7% of the company. Gold Mining Inc. is our largest shareholder at 12, 13%. They were, that's where the original assets came from. If you call that part of the inside group per se, they've held on to their shares, long-term strategic shareholders. So inclusive of that shareholding, you've got sort of about 20% within sort of the insider.
Right. We obviously talked about the projects that are going to come to fruition, but in terms of company milestones in 2026, what should investors look out for?
Yeah, yeah. So 2026 will continue on from 25 in that we should see additional incremental growth. In terms of what we're going to see in particular, we have a few assets that will have important catalysts. So Borborema I mentioned before, Aura Minerals project in Brazil, declared commercial production in Q4. That's commercial production. They should reach full run rate production in Q1 in 2026. That's going to result in likely a more fulsome revenue for us with our royalty. That's one. Another one in 2026, we saw a change in ownership of the operator at the Varus mine. So we acquired the copper stream in the Varus mine in Bosnia from Orion last year. Adriatic Metals was the prior operator. DPM Metals acquired Adriatic this year. DPM has put forward a plan to optimize that operation. It was through ramp up declared commercial production again this year, but in 2026 they've already put out some positive press around how they see that mine developing throughout the year. So we foresee a better than expected 26 as that ramps up through the year. So that's another one. Again, I mentioned, and this will be very exciting for us, is that when we see first production from Ren out of the Nevada Gold Mines extension into the northern zone at Gold Strike, that's another one that we should see come into the plan. And lastly, we have a royalty at the Isabella Pearl mine in Nevada. They're fully permitted to move into the next satellite pit, which is called County Line. That's one that should come into the plan in 2026 as well.
Right. Before we close this interview, is there anything else you'd want to go over with investors that might be watching it and why they should look into Gold Royalty Corp?
Yeah, yeah. So look, we feel that we have really reached a place in our history, short history, mind you, that we are a self-sustainable cash flow generating company. We've put together this portfolio, which has always had a high growth trajectory, but we're at the precipice of sort of seeing some of that come through, particularly with Ren and then with Odyssey. We backfilled it with good diversification of cash flow generating assets, which have brought us to that free cash flow positive place, but also will allow us to move the company forward in a much stronger financial position, looking at growing the company through additional acquisitions, but also organically just moving up from where we are, about 5,000 GEOs per year, or at 2026 to about 25,000 GEOs in 2029. We're very confident that that trajectory is achievable with the quality of operators that we have. So I think that there's a lot of value to be had from here going forward. We're in a very strong position, and we've got that same strong leadership team. We've got good relationships. We've got a very competent, strong team that will maximize value for shareholders. And, we have been successful at finding good assets to add to the mix, and we will continue to look at ways to maximize value for our shareholders.
All right.
Forward. Yeah.
Great. Well, that was Andrew Gubbles, the CFO of Gold Royalty Corp. Great to have you with us. And if you have any questions, we'll have their website and IR information in the caption below, or feel free to reach out.
Thank
Thank
you.
you.